So first of all, it's important to understand what bonds are and how they differ from equities, also known as stocks. When you invest in a stock, you are buying a piece of equity in a real business, making you a part owner of the company. If the business does well and the revenues and profits grow, the business becomes more valuable and the price of the shares goes up too. However, with bonds, you are not buying equity in a company or entity. Instead, you are simply loaning them money. Bonds are issued by companies or governments, and they pay a set rate of interest. Now, similar to stocks, the market value or price of an individual bond will fluctuate based on buyer demand as well as other factors like the Federal Reserve interest rates. And the interest rate that a bond pays is going to be based on the borrower's creditworthiness or risk associated with loaning them money. Higher quality bonds from reputable borrowers will actually pay a lower rate of interest, while lower quality bonds from less attractive borrowers are going to pay a higher rate of interest. Now, the bond maturity or the amount of time until repayment is due also has a lot of influence on the interest rate that a bond pays. Bonds with shorter maturities normally offer a lower interest rate as the risk is lower than a longer term maturity. Simply put, if somebody owes you money, there's normally less risk involved if they've agreed to pay you back sooner rather than later. So why do people invest in bonds? Well, the main reason is for diversification, which has the primary goal of mitigating risk from your portfolio. In order to understand this, we have to look at the differences between being a bondholder and a shareholder. As mentioned before, shareholders own equity in a company and they share in the potential successes or failures that a company then experiences. Bondholders, on the other hand, are just loaning money to a company for a predetermined rate of interest, and then once the bond matures, they return your principal or the amount of money that you loaned to them. This differentiation here between owning a part of a company versus just loaning them money makes bonds less risky than stocks, but there's also an important distinction about repayment during a bankruptcy situation. In the event that the issuer of a bond declares bankruptcy, investors holding bonds are much more likely to recover a part of their investment compared to shareholders. This chart from Fidelity helps us to fully understand this. At the very top, you have senior debt holders, which is normally the big banks. Below that, you have subordinated debt, which is where individual bondholders normally fall. In many cases, during a bankruptcy filing, there is still some money left over after paying the big banks, and ordinary bondholders will receive something. From there, you have preferred equity, which is going to be those who own preferred shares of the company, followed by common equity or holders of common stock in the company. The further down this pyramid you go, the higher your risk is of losing everything in a bankruptcy situation and thus receiving no payment whatsoever during their bankruptcy filing. So for that reason, among others, investors will often own a portfolio of stocks and bonds to have less overall risk associated with their investments. And as you get older, that diversification component becomes more and more important.